Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer and Portfolio Manager as well. I have Andrew Thrasher, Chartered Market Technician, also Portfolio Manager, and happy to have you all give us a few minutes of your time where we break down the events of this market, which has turned quite volatile. So first, before we get started, Andrew, do you have any opening words?
No opening words this time. We've got some interesting topics to cover. I think we're continuing one thing I really appreciate is I think we're kind of continuing the same theme each week where we've got a thread that runs through our topics. And I like the continuity that we've been having. So this is my way of giving us our own little pat on the back. I guess that's what that was. Good way to go, Andrew and Adam.
Well, we can allow that. I'll allow it. Yes, and actually we've shrunk it down here. We've gotten 3 topics so we can be concise and to the point. And they've been heavy lately just because there has been so much to unpack. And it's the same this week, but we're just going to give you 3. We're going to talk about real yields. One of the main themes from my perspective, as it's been all year, look at the big 4 stocks, ever so important for the direction of the market, and then look at central bank liquidity and how that's changing and how we might think about it in terms of stocks. So first, we're going to talk about real yields. Can be an abstract concept, but I think very, very important for financial markets. So when we're talking about real yields, let's just first think about regular yields. If you buy a treasury bond, you essentially have 2 components. On one hand, you're going to get a yield, but you're also going to have inflation along the way. So the difference between the two is ultimately going to be the real yield. And hopefully that's positive, but that's not been the case for fixed income investors for quite some time. And this here on the graph is a chart of the real return. And this, we could observe the real return or real yield in the market by simply looking at the yield on a treasury inflation protected security bond. When you buy one of those, you're locking in the inflation. So you're guaranteeing what that's going to be as measured by CPI. So what you're left with is a real yield. And they have been, as you can see here, steeply negative. And what's changed is that over the past week, they briefly went into positive territory. And so why that's significant is that we saw interest rates really begin to rise late last year and really firmly into this year. But the first chunk of that, the first leg of that happened without any change in real interest rates. What we've seen as a major factor as of late is that real interest rates have moved positive. And the easiest way to maybe understand why that's so important is real estate, probably the most important asset for your average household in the United States. If interest rates are going up because inflation is going up, that's not necessarily a bad thing for real estate investors because the property appreciation is there as well. But if interest rates are going up because the real interest rates go up, now your financing costs are going up as well and hard for new buyers. So that's not good or not healthy for a real estate market. So seeing this to go to positive is not the worst thing in the world, but it is taking away one of the major tailwinds that we've had, which is that if you're buying fixed income, you're locking in a negative after inflation return for a number of years. So you've got to put your money somewhere else. That has been a common theme going back to 2020. So that go to positive is a major change. And just for some reference, in the years leading up to COVID, before we had the COVID crash, the normal range was about 0 to 0.5. When they got up to 1%, Andrew, we'll remember the fourth quarter of 2018 all too well. When they got to 1%, that was a major factor behind basically crashing the market. So I'll let you add anything on the rates that you'd like to add, and then from there pivot on into your big 4 stocks, which I know you've got your eye on.
Yeah, Adam always does a great job with his analysis on the bond market, and bonds have really been a focal point this year. We're seeing for investment grade one of the largest drawdowns, the 3rd largest drawdown in over a decade. When we look at the aggregate index, it's actually one of the largest drawdowns that the aggregate index has been around. And so when you have those types of large drawdowns in price, you start seeing what Adam was discussing with where yield starts to pop back up. The implications that I view as a portfolio manager when I look at the market is when for the longest time stocks have been attractive relative to bonds because the yields have been so low. It's been there hasn't been a place to, especially in Europe, where they've had negative yields. So stocks have always been the better of the 2 options. And now that we're seeing where bonds are really starting to take a punch on the chin, those yields coming higher are going to start looking a little bit more attractive to yield chasers who have been kind of focused more on dividend type investing, trying to get yield income from dividends. So it really kind of changes the landscape for the market and the investable opportunities that people will have going forward now that we're seeing yields come back higher.
Yeah, absolutely. And it's really tough to get your mind around that we're now talking about a zero. And that means, you're locking in a 0% return for 10 years, and how that's better than what we've had for almost 2 years. But pivoting now to those big four stocks, so very important because of their sheer size and weighting in the market. I'll let you break down. I know this was one of the key points you shared with us on Monday, and I think couldn't be more important, especially this week as we go into a lot of the earnings for these big companies.
Yeah, so if we kind of back up, and when we last year, a topic that we were discussing a lot in our allocation meeting around September, October of last year was just how top heavy the market was getting. We started really breaking down the contribution of each stock to what the return was for the index. And ideally, you want to see a lot of players that are pulling their weight. If you think about it, pushing a stone up a hill, you want a lot of people, a lot of participation pushing to get that stone higher. When we start having less and less participation, less and less stocks contributing to the return of the overall index, that's when we start getting a little bit concerned. At the end of last year, we were noticing that a large chunk of the index return was just coming from the largest companies in the index. Looking at just the 30 stocks, the 30 biggest stocks in the S&P 500 contributed over 70% of the total gain through about mid-December. And so when we start looking at just the biggest four stocks, so fast forward to today, the largest four you see here, Apple, Microsoft, Amazon, Tesla, all probably names that you're familiar with. These four alone account for a little over 18% of the S&P 500. And so for a long time last year, investors were really focusing on those FANG stocks, those Facebooks, Amazon, Apple, Microsoft, Google. They started calling them FANG, just an abbreviation. And that's what was really helping drive the market higher. And so now we turn into 2022, we're getting a little bit more volatility. We're seeing stocks are coming down, and we're actually starting to see these mega caps, these FANG stocks are starting to underperform the market. And so when you have a very top heavy index where you have, again, these four account for over 18%, when they start to turn lower, that can then start to be a very heavy weight kind of around the neck of the overall market and start to pull it down as well. It makes it much harder for those smaller cap stocks that maybe are doing a little bit better. They're having better relative performance. There's not enough juice there, so to speak, in their market cap to counterbalance the decline you're seeing in these four. Today, again, as you know, we always record these videos on Tuesday. We're starting to see these four all beginning to underperform, seeing pretty big declines, especially as we're starting to get into earnings season. Tech in general just has really kind of struggled here recently. And just unfortunately, three of these four, you can almost call it Tesla a tech stock, but three of the four are heavily weighted in the technology space. So we're very much keyed in on these four. I did a media interview yesterday, said, what's the number one thing you're watching in the market right now? And I said, it's these four stocks, because I think if they can bounce higher, if we can start seeing buyers come back into these names, along with some other factors, then I think that's what's going to help buoy the market higher. However, on the other side, if we start seeing these stocks begin to break down, I think that could potentially lead to the next leg lower in equity markets. So we really want to keep an eye on these four equities and see how does the market treat them as we're starting to see some more weakness this week.
Thank you, sir. We're going to pivot to our last point, and really it's going to be a way that we tie these two things together. The way that real yields, which is really majorly affected by the central bank and the stocks, and look at central bank liquidity and how closely, surprisingly, or we'll say unsurprisingly, tied over the last several years.
Yeah, so again, we're looking at Apple, Amazon, Facebook, Google, Microsoft, Netflix, Tesla. The list is starting to get a little bit longer. We need another acronym for this group. But we're looking at the market cap of those in that light blue line, going back to 2009, coming out of the financial crisis when the Fed was really putting their foot on the gas, trying to provide stimulus through quantitative easing, lowering interest rates to historic lows, trying to do all they could to stimulate the economy. And they did. And that started getting things moving again. And they never really took the foot off the gas. They continued that quantitative easing. They continued to provide stimulus, and that was very beneficial to equity markets. The idea that can the Fed cause inflation, they very much did in the sense of financial markets, where we can see some of the largest companies at the time before here recently. Netflix actually was one of the largest companies. Now it's down roughly 70% from its high. But we saw some of the biggest companies in the stock market really had a strong correlation to the amount of liquidity the central bank was putting into the market. And so there was obviously, of course, other factors there, but the correlation can't be ignored. When the central bank was increasing its stimulus, these stocks were doing very well. So now we're at an impasse to where the central banks are starting to turn those spigots off, where they're not flooding the markets as much as they once were. And actually, in the back half of this year, they'll be pulling some of that liquidity out of the market. And so it doesn't take a lot of math to realize if they're pulling money out of the market, the things that were benefiting from all that liquidity, that ripe environment, could negatively be impacted. And that's part of the reason I think we're seeing the stock market right now not have a great trend. We're starting to see some more selling just because people realize this. They realize that as the Fed begins to raise interest rates, as they begin to pull out some of that liquidity, that all the things that were benefited from it could start to have a negative impact. And so they're kind of front running the selling there, so to speak. And then obviously a lot of other impacts with inflation and margins, and we could spend all day on all the different inputs there. But looking at this chart from Bank of America, it's stark to see the high correlation of the biggest stocks market cap and the Fed liquidity. And as we move into the back half of this year, some of the potential implications that could have.
Yeah, again, those all really tie together with one central theme on the Federal Reserve. And one thing that we can say, I mean, all this sounds bearish. Andrew nor I, neither one of us know exactly how this will unfold. What we can tell you is that a good chunk of the market has caught up to a bearish Federal Reserve forecast. That hasn't always been the case. And the difference there isn't which way the market's going to go, but we always have our eye on different segments of the market. I think we're to the point where there could be very well areas or groups that continue to do well, even if you would see the main four stocks continue to bleed away and pound the S&P 500. We're not tied to that S&P 500, and we're always on the lookout to concentrate and park out in areas that have some promise. So once again, as always, we're so appreciative of you giving a few minutes of your time to us, where we could at least share our thoughts and what we're thinking about the market as we certainly begin to pick up a little bit of heat. At least as of Tuesday, this week's recording. So hope you all have a great weekend. At first, though, don't forget to schedule your meeting with us, 800-928-4001, or scan the QR code there to pull up our website and book it online. And don't forget that we have a weekly radio show over the airwaves or however you get your podcast. Have a great weekend.